Welcome to the Investor Edge. Palantir just reported a quarter so massive it literally broke the standard valuation models. We are talking about 70% year-over-year revenue growth for a company already doing over $1 billion a quarter. But here is the shocker. While the US business is growing at triple digits, the international side is moving at a snail's pace.
That is exactly right, Mark. It is a tale of two companies. On one hand, you have this AI fever in the States, driving 137% growth in US commercial revenue. On the other, international commercial grew just 8%.
It raises a massive question. Is Palantir actually a global AI leader or just a US phenomenon?
Today, we are going to dive into the Rule of 40 score of 127%, the aggressive guidance for 2026, and the discrepancies that might be hidden behind the hype.
Let's talk numbers. Revenue for the fourth quarter hit $1.407 billion. That beat consensus estimates by nearly 6% and accelerated from 63% growth last quarter.
To put that in perspective, they reached a Rule of 40 score of 127. Now for our listeners, the Rule of 40 is a metric where you add your growth rate to your profit margin. Anything over 40 is considered elite for software companies. 127 is almost unheard of.
And the profitability is real. GAAP earnings per share, that is generally accepted accounting principles, came in at 24 cents. Adjusted earnings reached 25 cents, beating forecasts by 9%.
I also want to highlight the balance sheet. They have $7.2 billion in cash and zero debt. They are generating $791 million in free cash flow quarterly. That is a 56% margin.
But the real story was the guidance. Management is projecting revenue of over $7.1 billion for 2026. That is 15% higher than what analysts were expecting.
It is bold, Mark. They are betting that the U.S. commercial segment alone will grow another 115% next year.
Here's where it gets interesting. We found three major discrepancies between what management said and what the data actually shows. First, the global leader narrative. CEO Alex Karp says they are the future for all Western allied nations.
But the numbers show a two-speed business. The U.S. now commands 77% of total revenue. International commercial growth is basically stagnant at 8%. Management blames a slow pace of maturity in Europe. But the biggest red flag we found is that they might be struggling to replicate their U.S. sales model abroad.
Discrepancy number two, the N of 1 claim. Karp insists they have no direct peers.
While their 70% growth does dwarf peers like Snowflake or Datadog, which are growing in the 20 to 30% range, those companies don't trade at 140 times forward earnings. The discrepancy isn't the performance, it's the price you pay for it.
Finally, let's look at profitability. Management claims hypergrowth and profit aren't mutually exclusive.
This one actually checks out, but with a footnote. Their GAAP net income of $609 million included one-time tax benefits. However, even without those, their real profitability is high. The good news? Stock-based compensation, where companies pay employees in shares, is down to 14% of revenue from 25%. That is a major green flag, because it means less dilution for shareholders.
If you are a short-term trader, here is the educational framework. The stock has been volatile, currently sitting around $139. Technical analysis shows a support level at $130 and a medium-term floor at $123.
We are also seeing the RSI, or Relative Strength Index, at 27.35. For those learning technicals, anything under 30 is oversold. This suggests a potential near-term bounce. Resistance, where the stock might face selling pressure, is at $155.
Now, let's look at the long-term 1 to 3 year thesis. If you believe the bull case, you are betting Palantir becomes the industrial operating system of the West.
If revenue hits $15 billion by 2028 and they maintain 50% margins, the math suggests a target of $260 per share. That assumes they keep their monopoly power in the ontology layer where companies like Snowflake can't compete.
But the bear case is all about valuation compression. If you believe the AI spending spree is a hype cycle, the risks are high.
Exactly. If U.S. demand saturates and international growth remains a drag, investors might refuse to pay that massive premium. If the price-to-earnings ratio compresses to 50, the sector average, the stock could fall to $95 even if the business stays solid.
For growth investors, that 61% revenue guide for next year is the strongest in the sector. For value investors, a 140 times forward PE ratio is likely too expensive. And for income seekers, there is no dividend. They are hoarding $7 billion for future opportunities. The key takeaway today: Palantir is firing on all cylinders in the US, but the international stall is a yellow flag that cannot be ignored.
It is a high-conviction watch for most and a hold for those who got in early. The valuation leaves zero margin for error.
That wraps up today's deep dive on ticker PLTR. If you found this analysis helpful, please like the video, subscribe to The Investor Edge, leave us a 5-star review, share this episode with a fellow investor, and follow us on Spotify, YouTube, and X. If you want us to cover a specific stock, please email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for watching.